Welcome to the FinLink Fincast, where we talk about everything wealth management, especially as it pertains to M&A. Here is your host, Xander Heinen.
Welcome to the FinLink Fincast. I'm your host, Xander Heinen. Today we have a special guest, Todd Steinberg from Thrive Financial Group. Todd is really one of our first resource partners for our CPA subscribers. And it really has been in the industry for a very long time and a true pioneer in the M&A space for CPAs. Welcome, Todd. Thanks so much for joining today.
Yeah, thank you, Xander. It's great to be with you, and I know we've gotten to know each other. It's been a great process getting to understand a little bit more about what you're doing here with FinLink, and just happy to be able to provide my unique lens, what I've seen over the years as it relates to accounting firm M&A. So yeah, we at Thrive, we're very laser focused on working exclusively with accountants. So what we do is we help facilitate as an intermediary, bringing buyers and sellers together, typically working with smaller to mid-sized firms. So think anything from maybe a couple 100,000 up to about 5 million is our sweet spot.
Excellent. And give us a little background on yourself. I know you've been in the industry a long time, and I think this was the first industry you started in, right? It was like marketing for CPAs back when you
Yeah.
were a youngster.
Yeah, it's kind of crazy. I mean, I'm 46, but I've been in the industry since the ripe old age of 15, believe it or not.
Wow.
Yeah, it's just real quick. My neighbor was the founder and CEO of a consulting firm that specialized in working with accountants to help them organically build their practices. So, like marketing and sales strategies, as most accountants will admit, they're not the best marketers. So, we were creating a process for them, and I spent 25 years in that organization. Kind of grew up in that world. And then around 2017, I decided to take the plunge and kind of go out on my own, other than a little hiatus and helping accountants integrate financial planning. So that is something I have some experience in working with CPAs and financial advisors to help them better serve the needs of their clients. But really, since 2017, we've been working exclusively with accountants and have served now as an intermediary in over 400 transactions across the country.
Wow, that's a good chunk. And boy, has that changed over that time period. The advances that have happened in CPA are pretty amazing. Well, let's step back a sec and just let's get a quick overview of market trends. Maybe we could get into valuations a little bit. I don't want to spend too much time on that. I really do want to dig into, what your process is for sellers and for buyers, and how you and I are going to be working alongside. But yeah, I'd love to hear, it's a hot market in the financial advisory space, as I know well. And I do see that in the CPA space as well, but slightly different. So
Yeah.
would love to hear, what the current market looks like, and what multiples are looking like. That's always a huge topic, as you know.
It certainly is. So yeah, it's interesting. The last 3 years, there's been more change in how M&A has worked in the accounting industry than probably in the first 27 years of my career combined. In the older days, it was accounting firm buys accounting firm or accountant buys accounting firm. Now, you've got institutional investors, you've got wealth advisors, you've got private equity groups. It is a hot industry, as you pointed out, and for a multitude of reasons. I mean, when you think about the stickiness, the recurrence of revenue of accounting and tax clients, the opportunity to kind of come in as the trusted advisor to the clients of the accounting or CPA firm, to then be able to offer other ancillary services, whether that be wealth management or other family office related services. There's a multitude of things that many of the top accounting firms are offering to be able to kind of hang themselves out as the quarterback for all things financial for their trusted clients. So when you combine that along with what were historically, compared to other industries, lower multiples to be able to acquire, it became this sort of perfect storm, where now the level of interest in our industry is at like a fever pitch. I've never seen anything like it. So as a broker, who represents sellers, which is how we operate. It's my job to find a qualified buyer, not only good economic terms, but also somebody who's going to be a good fit, culture, personality, level of service. Same thing a financial advisor or anyone else selling a service business would want to be able to find. So it becomes important to be able to find that right balance. And I think that's where some of the trends have started to shift from investor groups or PE groups who really in the beginning didn't have a platform to be able to say, we're in this space. Fast forward a couple of years, now many of them have had success. They've acquired a firm or 10 firms or 15 firms. So to call them a PE group today would be not really accurate when they're more of an accounting platform and in some cases a top 100 or top 200 accounting firm in the country. So there's a lot of aggregators out there. There's a lot of consolidation that's happening in the industry. As to whether that's going to be good or bad for the industry as a whole, I guess time will tell. But it certainly has been an interesting time. And just to touch on valuations, a few years back, the golden rule was anywhere from 1 times revenue to maybe 1.25 times revenue. Mostly cash deals are kind of what we had been seeing for our clients. There's some combination of personal funds and outside third-party financing with a small seller note. Today, those same 1 to 1.25 valuations, now they're as high as 2 times revenue. You're starting to get more valuations that look at what traditional investors and PE groups will oftentimes use as an indicator of value and total enterprise value, which are now multiples of SDE or EBITDA. So you can be as high as 6, 8, 9, 10 times SDE or EBITDA. For small firms, that usually caps out at about 4 to 5 times SDE or EBITDA. So the valuation game is changing now. So stay tuned. It's an exciting time, but I'm certainly happy and excited to be a part of what has now been a very hot and growing industry.
Good point there. And I've heard you describe this before, but it really comes down to profitability on what multiple, acronym you're using. Can you just explain to us, the differences in the EBITDA multiple? Usually how I explain it is it comes down to profitability, and the larger the business is, the more enterprise like it's usually a larger multiple of EBITDA, and then the smaller sole practitioner offices are usually revenue based multiples.
Yeah. So really anything above 5 million, you get into the STE EBITDA multiples and higher valuations. In the small to mid-sized firms, which is typically in the sandbox that I'm playing, I'd say the bulk of them are still a multiple of revenue, with the average being around 1.25. Profitability is certainly a driving factor. There's no question about that. Because ultimately, if the seller's going to get a mostly cash deal, many buyers don't have a couple $1,000,000 laying around, so they got to go borrow that money. These are cash flow lenders, as you probably know all too well, Xander, right? So it has to be able to meet the debt service, and under a certain threshold, the numbers don't work. Similarly, above a certain threshold, I mean, the SBA financing sort of caps out, in my experience, at about 3.5 times SDE or EBITDA. So yes, profitability is a component, but there certainly are other major contributing factors, and these are really in no particular order, but I would offer up that client mix, like accounting, bookkeeping, compilation, payroll, valued slightly differently than income tax or consulting or one-off projects. Then you have staff. A lot of people are acquiring practices for the human capital today, not just for the top line revenue, but for the people, because they're so hard to find in the accounting industry right now. So that's a major factor. And what type of transition assistance is the seller willing to provide? If that's a longer runway, that's usually helpful to maintain client retention, minimize attrition. And then also location. A firm in a major metropolitan area will oftentimes sell for more than one would in a more rural market. Same reason why a virtual firm, because they can acquire and run it from anywhere, would be slightly more valuable than a brick and mortar. So those are the main factors. But I would also just add that as it relates to the profitability, beauty can lie in the eye of the beholder. And what I mean when I say that is, you might have $1 million firm where the owner works a ton. They have a great profit margin, strong SDE, EBITDA, but they're working a lot. They don't really have a team behind them. They don't really have a nice office, or they don't use the best software. Then you might have another $1 million firm that has a great team. Maybe their net is slightly lower. Maybe if it's 50% in the first example, maybe it's only 30% here. But it's a lifestyle that the seller can take 9 weeks vacation per year and only works 25 hours a week and has a great team in place that they can leverage and delegate, very turnkey. So, who am I to say which firm is more valuable? From a lending perspective, it's probably the first example. If it's somebody who's looking at this as a business, they might see the second one as the better example. So I try to be a little careful in saying one is more attractive or better than the other. It's just one might be a little bit more easy to borrow against than the other.
Right. Yep. Good point. So what are you seeing as far as, I know you mentioned, really the ramp up in activity. It's at a crazy height right now. I have my own number and what I see at FinLink and from what I hear from other consultants, but in the CPA world, per seller, how many buyers would you say are out there?
Yeah, boy. I am at a point now where a number of inquiries from qualified prospects. Let's just cut out the unqualifieds, because there's a lot of unqualifieds that are wannabes that want to get into the space. But those that have a real chance, whether they're accounting firms or accountants or platforms that are PE backed or institutional investor backed, for most good, decent firms, the average would be between 15 to 20 buyers. So it's basically not just terms and price, because they can probably get a great deal from a handful of them, but it's that combination that I think most financial advisors would tell you, most accountants would tell you. It's that combination of fit, overall, the economics, but then also what's a soft landing for me and my team and what's best for my clients. So usually there's a leader in the clubhouse that brings all those elements together, and ultimately they end up winning it. So it's always been a seller's market for as long as I've been selling accounting firms, but it probably has been 100% increase over the last 3 years. So it becomes imperative that we screen and qualify buyers probably now more than ever, so that and the sellers are only meeting with qualified, capable buyers.
And that's a term that's being thrown around a lot now, is the qualified buyer. Can you go into a little depth of what your process is on, say, a buyer reaches out to you, how do you qualify them in Thrive to, be able to know that their financials are right, their transition is, can go
Yeah.
seamlessly, their staff is correct. What do you guys see over there?
Yeah,
Or
so a
what's your
little bit of
process?
that will depend on the firm that I'm representing. If it's a firm that has a niche or some high degree of specialization, I've got to make sure they've got that expertise to be able to actually do the work. But I'm looking for, if it's like a general, let's just call it your typical Main Street CPA firm, bookkeeping, tax, payroll, some advisory. I want to make sure I have a resume, so I know what their credentials are, what their experience is. I want to make sure I have a personal financial statement from that buyer, so I know they're qualified financially. And if they don't have the capital set aside, that's okay, because of course, as we discussed, there are financing programs out there that will provide up to 100% financing. In some cases, it's 80, 90%. But if they can borrow, that's okay. I have no problem with that, as long as the check clears the bank. I don't care where it's coming from. And then the other thing would be from a confidentiality side. I want to make sure that we're not sharing any information with anybody that isn't pre-qualified from a non-disclosure perspective. So it's really economically or financially, confidentiality, as well as experience. So if they pass that initial sniff test, and I think they could be a good fit for the firm or the seller that I'm representing, then I'm happy to make an introduction. And as I often will say, I can set up a blind date, but I can't make you fall in love with one another. So meaning, like, I can connect people and firms, but ultimately it's got to be a good fit. And if the seller and the buyer both feel that it's a good fit after initial dialogue or meeting, then we can start to get into more of the economics and the negotiating to see if we can come to terms.
I've probably had that conversation 5,000 times, and I preface it with fit is first. So it really is important. You are going to avoid a lot of landmines in your career going forward if you have a appropriate fit, whether you're a buyer or a seller.
Yeah.
Let's transition over to the sell side real briefly here. What is that market looking like? I understand, you and I had discussed the silver tsunami prior. There's going to be a huge gap in older advisors phasing out and, not enough younger CPAs coming in, or EAs, advisory folk, or accounting folk. What's that looking like? Why are these folks exiting? What is the makeup of, that you're seeing at least? Is it majority private equity? Is it smaller buyers? Assuming these, again, it goes to the correct fit, but I'd love to hear your take.
Yeah. So first point would be, why are they exiting? I think it's, you have the aging population, so naturally there's going to be more people of age. And then you also have, in my experience, a motivation for wanting to sell is they've taken the firm, the owner has taken it as far as they can without being able to tap into the resources of something a little larger than themselves, right? So if you're at the helm of a $4 million firm, it's hard to compete with the 20 and 50 and $100 million firms that are offering other ancillary services. You're so busy trying to just handle the blocking and tackling of being a CPA that it's hard to add wealth management. It's hard to add advisory services. So some of them realize they're kind of at an inflection point there. And then I think this other piece is people who don't often want to add other services, but they don't want to reinvent themselves at this stage of their career for various reasons. And I can't say I blame somebody who's 60 years old and has maybe 5 or 10 years left, and they want to pivot from being a backwards looking historian or compliance shop to a forward looking advisor. And I mean, this is not my take on the industry. This is where the puck has been going for the last 5-10 years, is that accountants are now expected to be more advisory driven, right? Provide more proactive planning, proactive advice. So it's hard to teach an old dog a new trick. So some of them just say, you know what, the tax law is getting more complex. There's more changes than ever. I don't want to be an advisor. I'm gonna get out. Or maybe I'll merge and I'll just do the things within my practice that I actually enjoy, whether that's business development or other aspects. So that's why people, I think, are exiting. As to who's buying firms now, it's still a lot of individual buyers that are going the SBA financing route and acquiring a business and stepping in. So you still see a good amount of that. Probably a third of the transactions that I do fall into that bucket. Another third would be existing accounting firms, either similar size to the firm they're buying or maybe slightly larger, that have capacity, have bandwidth, bring other resources to the table, can give the seller a place to call home for the next few years until they ride off into the sunset. And then probably the last third would be your PE groups and your investors, which for the right seller can be a great spot. I'll say normally those firms that have a younger partner that can see themselves staying in the firm for quite a few more years. Maybe there's some rollover equity so that they can have at some point maybe a second bite of the apple. And they're paying great terms. There's no financing needed, and they've got good business people in leadership. So they're making a very compelling case. And a couple of years ago, I was hesitant to recommend a few of these PE groups because they were so new. But now, fast forward 3 years, many of those same groups that I was hesitant to recommend are some of the fastest growing accounting firms in the country. So now they're getting their foot in the door from my listings, and I think they're having a lot of success with other brokers in our space as well.
One thing you mentioned earlier in the podcast was, wealth advisors buying CPA books. I know you and I have some common relationships with wealth advisors who've successfully done that. I would love to hear your take on, what that looks like, what those initial meetings, the exploratory meetings must be like, because you have two very different personality types trying to merge here.
Yeah, as I mentioned in my background, I did spend a few years helping kind of connect CPAs and financial advisors to work together. So I think at the core of it, it better behooves the needs of the client when a CPA and financial advisor are working together, whether they're part of the same organization or whether they're partnering. I do think it's a great thing for the industry, and more accounting firms are offering this, whether it's in-house or through a partnership program, which is the type that I was promoting. But I would share with you this, that financial advisors, they are a different personality type than CPAs, naturally. And what I find is that the CPA is hesitant in many cases to want to talk to a financial advisor. Why? Because they've been getting approached since the dawn of time about partner with me. I'm a great financial advisor. I'll refer clients to you, or I'll share revenue with you. But the CPA is afraid that now they're kind of losing some independence, or they may not be getting good advice from that financial advisor. So they're really trying to protect their clients' best interests. So I think they're a little hesitant to sell unless they know that the financial advisor has a champion, whether that's a CPA, an EA, or somebody that could step in and fill the shoes of the accountant or accountants that are looking to sell. Because let's face it, it is a completely different industry, different set of rules, compliance. It's vastly different. So they're going to be a little bit more skeptical, I think, until they know a little bit more about what the game plan is. So what I tell financial advisors is come to the table, come to the discussion initially with an accountant. It's not that they won't talk to you, but they want to know who is going to be coming in alongside you to help run point on this acquisition, if in fact you're going to be the winner. So it's easy to sell the idea of merging services and having that all under one roof or a one-stop shop, but they're going to want to make sure that you've got a CPA or an accountant that can help really run the business and be the champion. And if you do that, then you've got as good a chance as anybody to be the final winner, or the ultimately the successor to that accounting firm.
Yeah, so now the sellers have all the flavors that are bidding for them, drooling over them, I would say at this point. As I think I mentioned to you, we have 13,000 members on FinLink out of the 80,000 active members. Well, we have that do not have a succession plan. A lot of them are probably sellers who maybe be merging, may not want to take the exit now. Maybe they want to do it 2 to 3 years, take some chips off the table. What should they be doing to maximize their value so that when that event happens, whether that be, a partial equity sale, or a merge, or some, type of full sell, what process should they be taking to maximize that enterprise value?
Yeah, so you're right. It's never really too early to start doing some succession planning. Most people that ultimately end up talking with us, it's not because they're waving the white flag saying, get me out of here, I'm done, this tax season's my last. It's usually they've been kind of building up to this moment for the last few years. And there are a lot of steps that you can take to maximize the value of your business. What I see as some of the more common ones in today's day and age is they're outsourcing routine tasks, whether that's onshore or offshore. So think compliance work, bookkeeping, tax. They're shifting to more of an advisory focus. They are doing some expense cutting, and to the extent that they can without jeopardizing their staff or their deliverables. So maximizing the profitability of the firm, making sure that they've got good talent, that they can delegate to the extent that they can bring on new clients. They don't have to turn work away. It seems to be an issue right now. Many clients I talk to, they can't even take on any more business. So when they lose some through normal attrition, their revenues are starting to go down. So buyers want to see a steady increase. They want to have predictability. They want to have a good team in place. So it's never too early to start to have that conversation. I would tell anybody who's considering selling that you really should start the process about a year before you anticipate closing the transaction. And then it's prudent that you be involved for a multitude of reasons, which I won't get into here, but for a multitude of reasons, to stay on for at least a year, maybe 2, to help ensure a successful transfer of that goodwill and those relationships, both staff and clientele, to make sure that it's a good experience for everybody involved.
I think that's really sound advice. I've seen, the lack of any type of integration with the former owner and it's not been good in some cases when I was working at the bank. And just to kind of end here, I know you don't have a crystal ball. Everybody has a crystal ball, but it's foggy. What are you seeing in the next 12 to 24 months in the marketplace? Do you think it's just going to keep ramping up? I know there's a huge amount of variables there,
Yeah.
but would love to hear your thoughts.
So my lens is my crystal ball would tell me that what was 2 years ago, large investors, PE groups that wanted to deal with the $10 million and north firms, it's coming for the small firms. It's already here. So I think that's going to continue, where you have a lot of outside investors and PE groups that are looking at a couple $100,000 firms, not just a couple million. So I think that's here to stay. I don't think that's going to change anytime soon. As I said, since I've been in the business, it's always been a seller's market. It's just really going to be a question of what multiples do and how valuations are changing. They're on the uptick now. I hope that continues. There's certainly going to be a lot of consolidation, a lot of roll-up strategy. So what that will do to the future of the industry, I'm excited to see what that's going to ultimately, how that's going to play out. But there certainly is more activity happening today, more M&A than there ever has been before. And I think ultimately it's kind of leading the charge to make these firms more relevant and ultimately be able to provide a better service to the trusted needs of their clients. Because if they don't offer a more robust package of services, they're going to get dusted and left behind by some of these other firms that are coming in with a better technology stack, with more service offerings, with a greater reach and team, as opposed to just the 1 or 2 person firm who's been doing the bookkeeping and taxes for the last 15 years. Those firms, I think, are going to have a hard time competing and thriving in an environment here moving forward.
Yeah. Well, I really appreciate your time today, Todd. It's awesome having you on finally. I know we've been trying to put this together for a while, so thank you so much. And for all of our FinLink subscribers, Todd Steinberg, you can reach them through our resource page at Thrive. We'll be doing a lot more together, so don't worry about that. But yeah, we'd love to have you on again. And Todd, we're really looking forward to evolving the relationship in the CPA space with you and Thrive. So thanks so much for being a resource partner, and I look forward to doing this again.
Yeah, I really enjoyed the conversation. Appreciate the opportunity to join you and looking forward to continuing to collaborate here moving forward.
Excellent. Have a great day, Todd.